Back in 2024, I made a bold prediction that the Federal Reserve would fire up the money printers again in 2026. And guess what? 2026 is literally right around the corner, and we're already seeing the signs that I was right. In fact, quantitative tightening officially ends on December 1st. That's not speculation, that's confirmed by the Federal Reserve itself. And here's what most people missed. The Fed president in New York, John Williams, just said in November that the Federal Reserve will soon need to grow its balance sheet again. That's just a fancy way of saying they're about to turn the money printers back on. And he didn't say maybe or years from now. He said he expects it's not going to be long before it happens. So if you've been struggling with high prices, watching your savings lose value, or feeling like you're falling further behind while the wealthy keep getting richer, what I'm about to explain is critical. Because when the Fed starts printing money again, it's going to create what experts are calling a meltup. And if you don't understand what that means for your money, you're going to get left behind. I've read through the Fed statements, the Wall Street analysis, and the warnings from some of the world's top investors so you don't have to. Let me break down exactly what's coming and what you need to do to protect yourself. Okay, so let me clarify some terms, because the Fed uses fancy language to hide what they're really doing. Quantitative easing, QE, balance sheet expansion, reserve management. These are all just different ways of saying the same thing. Money printing. When they print money, it floods the financial system with more cash and more liquidity, which energizes the economy in the short term. But here's the problem. What happens when there's too much money chasing the same amount of goods and services? Prices inflate higher. And this wouldn't be such a disaster if everyone received an equal amount of that newly printed money. But of course, that never happens. The money goes to banks, institutions, and asset owners first, and by the time it trickles down to regular people, you're just dealing with higher prices. Now, when there's too much money in the system and inflation is soaring, the Fed has to reverse course. They do something called quantitative tightening, QT, which is the opposite of money printing. They drain liquidity out of the system. And that's exactly what they've been doing for the past 3 years. Let me give you a quick recap to bring you up to speed. The pandemic happened, and the government told millions of Americans to stay home and not work unless they were essential workers. That destroyed the economy. To save it from this self-inflicted wound, they printed trillions of dollars, which of course caused raging inflation. Because how else would people pay their bills if they couldn't work? But here's the thing. They overprinted. They printed way too much money. So for the past 3 years, the Federal Reserve has been shrinking their balance sheet from $9 trillion down to $6.6 trillion. They've been removing money from the system to tame inflation. And now they're stopping that process completely on December 1st. The quantitative tightening is over. And all the signs point to them starting quantitative easing, money printing, again very soon. This isn't just me making predictions. Listen to what the actual Federal Reserve officials are saying. John Williams, the New York Fed president, said the Fed will need to grow its balance sheet soon, and he expects it won't be long. Jerome Powell, who's the chair of the Federal Reserve, said in October that at a certain point, reserves will have to start growing gradually. Dallas Fed President Lori Logan said if repo rates keep rising, the Federal Reserve will need to begin buying assets. Again, another way of saying money printing. And it's not just Fed officials. Evercore, one of Wall Street's most respected macro firms, said the Federal Reserve may need to buy up to $50 billion per month in the first quarter of 2025. Here's a really important question. Why is the Fed doing this right now? The economy isn't crashing, at least not yet. They're not responding to some immediate crisis happening this very moment. The real reason is about the mechanics of the financial system itself. The financial system cannot function properly without enough reserves. Think of the banking system like a plumbing system. It runs on reserves, the repo market, collateral, treasury bills, and short-term financing. If there's not enough water in the plumbing system, it doesn't function properly. The Federal Reserve has been shrinking their balance sheet, and reserves have been falling. If reserves go down too far, repo rates spike up. And when that happens, the money markets break. We already saw this happen in 2019 with the repo crisis, again in 2020 because of the pandemic, and we're seeing warning signs again in 2025. So yes, the Federal Reserve is stepping back in, But they're not doing it to stimulate the economy directly. They're doing it to keep the financial plumbing system from breaking. But here's the critical part. When the Federal Reserve expands their balance sheet, there's always an effect. More liquidity in the system means lower real yields, higher valuations, increased risk-taking, and more upward pressure on financial assets. This is where it gets personal for people like you and me. When the Fed starts printing money again, it doesn't affect everyone equally, not even close. If you own stocks, real estate, or other investments, you're probably going to see those values go up. That's what people call the meltup, asset prices rising rapidly. But if you're living paycheck to paycheck, renting your home, and keeping your savings in a regular bank account, you're the one who gets hurt most. Your purchasing power erodes while asset owners get richer. This affects renters who are already struggling with housing costs, workers whose wages aren't keeping up, savers with money in low-interest accounts, anyone on fixed income like retirees or people receiving disability, and young people trying to save for their first home. If you're working class or middle class without significant investments, this policy makes it harder to get ahead. And it's not just me sounding the alarm. Ray Dalio, founder of Bridgewater, one of the largest and most influential hedge funds in the world, is saying the Federal Reserve is basically stimulating into a bubble. He says the key ingredients are already there: high stock prices, large fiscal deficits, high inflation, and now new quantitative easing coming. Dalio's pointing out that this combination is very inflationary and very dangerous. He expects this additional liquidity is going to push investment prices higher and higher until inflation becomes so severe that the Federal Reserve has to slam on the brakes, causing a severe correction. Let me make this crystal clear. Dalio is saying there's going to be a melt-up. He's saying when we melt up, that's the time to sell, not right now. He's not telling people to sell today. He's saying ride the wave up, but get out before the crash. Here's something huge that most people aren't talking about. Jerome Powell's term as Fed chair expires in May of 2026. Who gets to choose his replacement? President Trump. And if you've been following the news, you know Trump's stance on the Federal Reserve. He's repeatedly said interest rates are too high, the Fed was too slow to cut rates, and that the Fed should support growth, help manufacturing and exports, and provide lower borrowing costs. So what happens when the next Fed chair aligns more closely with Trump's views on monetary policy? You can expect a more dovish Federal Reserve, meaning more tolerance for inflation, more willingness to cut interest rates aggressively, and more support for growth and liquidity. Let's add that to the mix of ingredients we're already working with. We have high stock prices, large fiscal deficits, high inflation, new quantitative easing coming, and now a more dovish Federal Reserve. When I look at that combination, I see melt-up written all over it. Here's what you need to understand. The Federal Reserve is warming up the money printers. You can call it QE, balance sheet expansion, reserve management, technical operations, whatever fancy term they want to use. What matters is that liquidity is coming back into the system. And remember what I've been saying. Interest rate cuts come first. Then they stop quantitative tightening. Then they turn the money printers back on, and then inflation reaccelerates. Every money printing cycle requires a greater quantity of money to be printed. Think of it like an addict requiring a greater dosage, and it's going to end very badly. Now let's talk about what you can actually do with this information. Understanding that liquidity is coming is one thing, but positioning yourself for it is something else entirely. I want to give you some practical, common-sense ways to approach this. First, follow the liquidity, not the headlines. When the Federal Reserve adds liquidity, even if they don't call it quantitative easing, even if they use some fancy technical term, the market is going to react like it's stimulus. This typically means higher valuations, compression in yields, and more risk-taking. You don't have to predict anything. You just have to understand that liquidity drives the markets. Second, don't chase the melt-up at the top. Build your positions during pullbacks. It's not going to go up in a straight line. Smart investors don't chase parabolic moves. They buy the dips, not the euphoric spikes. You don't have to time the bottom perfectly. You just have to avoid chasing the very top. Third, diversify across multiple asset classes. Don't put all your eggs in one basket. Don't make one big bet. In liquidity-driven environments, stocks can go up. Crypto can go up. Precious metals can go up. Nobody knows for sure which will be the fastest horse in the race. Think about it like this. If you believe stocks will outperform, do you buy a broad basket like the S&P 500? Or do you focus on AI stocks or energy stocks because AI requires more power? If you think crypto will do best, do you just buy Bitcoin or do you buy altcoins? Even within precious metals, do you buy gold, silver, platinum, or mining stocks? Listen, I'm not saying you need to buy a little bit of everything, but you should be diversified across asset classes. Let me speak plainly. If you're a crypto person who only buys crypto, diversify some of that into precious metals or stocks. If you're hardcore about precious metals, think about putting some money into equities. Stay diversified. Fourth, be extremely careful with margin debt. This is so important because I've seen so many people get ruined by this. Even in a meltup, investments don't go straight up. There will be pullbacks and downswings. If you borrow money to buy stocks or crypto, that's called margin debt. You can get wiped out in a temporary downswing and not be able to recover when it bounces back. Let me give you an example. If you have $100,000 to invest, you can buy up to $300,000 worth of stocks or crypto with margin debt. But if your investments drop 33%, you lose your entire $100,000. And when the market goes back up, you won't have any money left to enjoy the recovery. People get wiped out in raging bull markets because of dangerous debt levels. Don't let that happen to you. I know this all sounds intense, and I'm not going to sugarcoat the challenges. The system is designed in a way that helps people who already have money first. But that doesn't mean you're helpless. The good news is that if you understand what's happening and position yourself appropriately, you can actually benefit. Lower borrowing costs mean it's cheaper to refinance debt or consolidate high-interest credit cards. Strong job markets mean better opportunities for raises and promotions. And if you can start investing, even with small amounts, you can participate in rising asset prices instead of just watching from the sidelines. The key is education and action. The wealthy have been playing this game for decades. They know when the Fed prints money, assets go up, so they buy more assets. There's no reason you can't start doing the same thing on whatever scale works for your situation. Look, I created this channel to help regular people understand these complex economic topics and actually do something about them. If this video helped you understand what's coming and how to position yourself, please hit that subscribe button and turn on notifications. I'm constantly breaking down Fed policy, inflation, market trends, and practical money strategies. Check out my other videos on building wealth during inflationary periods and protecting your purchasing power. They're linked above. Remember, knowledge is power when it comes to money. The more you understand about how the Federal Reserve works and how their decisions affect your daily life, the better equipped you are to protect yourself and potentially come out ahead. Thank you so much for watching and happy Thanksgiving. I'll see you in the next video.